This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and I'd like to welcome all of you, especially the new attendees. I'm looking at the list of folks that have signed in tonight, and I see a lot of fresh names, and I can't say new faces, obviously, because I can't see you. But there's a little icon on the control panel there. If you could raise your hand if this is the first time you've participated or at least attended a Market Guy open house, just by a show of hands. Let me see. You can click on that. This will also give you some practice on how to ask a question, which I'll get into. Thank you, Katie. Thank you very much. And if you do have a question as we go along, I'm using the question. There's another one that says questions. That's where I'm going to be looking for questions, not in the chat box. The chat is not going to be used. So when the time comes, I will be asking for stock symbols, and then we'll analyze those stocks. But don't put those in yet, because what happens is if you put them in too early and then people ask questions along the way, then it gets wiped off the board. It's a scrolling Q&A box. So I want to make sure that I'm getting everyone's stock symbols. So we'll get started right now. This is a one-year daily chart of the volatility index, and I usually go through the major markets first, and then I get to the volatility index last. But I'm starting with the volatility index because I really want you to see what's going on here. I'm going to switch to a 20-year monthly chart so I can show you what's happening. And if you could see my cursor here, these lows down here, right around $10, $10, $11 right here, was what the markets look like right before the crash of 2008. And that is one of the major signals that I look for, is a low volatility index reading, which generally signals a market top. Now, the interesting thing that's happened, and it's the first time it's happened in my career, is that we did not get any kind of a sell-off or correction when our new President Trump came into office. And this can only be explained by what I'm calling the Trump effect, because if you look at Dow theory, and this goes back to the early 1900s, Charles Dow created the Dow Jones Industrial Average as a way to monitor or forecast the economy. It had nothing to do at the time with analyzing or forecasting stock market action. Charles Dow created the Dow Index because he wanted to forecast the economy. So the theory behind this, and again, the Dow theory, is that if you could monitor and track the progress and profits of the top 30 stocks that drive the U.S. economy, then you could forecast the U.S. economy as a whole. And the Dow Jones Industrial Average generally precedes the economic trend by about 9 months. So another way to look at this is, if we see the Dow Jones Industrial Average increasing, then that means that we're bullish on the economy. And if you, whether you like Trump or not, you have to understand that one of his campaign promises outside of national security was that and listen, I'm from New York, and I understand Donald Trump has a pretty big ego, probably larger than Manhattan and the Bronx combined. But he came out in one of his rallies and said, "I'm going to be the greatest jobs president that God ever created." And I think his ego is too big for him to fail in that department. I think he actually will go down in history as one of the greatest jobs presidents, maybe even more so than Ronald Reagan. So the market is reacting to that in a positive way. Now, this is really a double-edged sword here because, again, I've never seen the volatility index hover around these lows for this long without getting some kind of a uptick in the volatility index. So again, here we are with a 20-year chart of the volatility index hovering around the 20-year lows, and I'm forecasting that we're going to see a market pullback. I don't think that we're going to see a market collapse. I had at one point thought we're going to see a major market collapse that could be 3,000 or 4,000 points, or maybe even up to 7,000 points. That's what I was looking at 2 years ago, in fact, when I was looking at the employment participation rate, jobless claims, and such. And it was looking pretty grim, but all of a sudden, things in the job market are looking pretty optimistic. Now, I'm not backpedaling and saying we're not going to see a major market correction. In fact, on the contrary, I think our market needs, it very much needs, a correction to stay healthy. Otherwise, what happens is we wind up in a bubble. Now keep this volatility index in mind here as I now switch to a weekly. I'm going to switch to a weekly chart looking at the Russell 2000. Now here's the Russell 2000. Now if you've been, excuse me one second. I still have a little bit of a chest cold, so I didn't want to cough in your ear. I just muted. All right. So if you followed along with the weekly market report, you'll know that these are the lines that I drew from last week's report. And these lines are called fan lines. And for some of you, I think you're very well versed in fan lines, but I could never overstress the importance of fan lines and what they mean. Now, when I show you these fan lines, keep in mind that most of the time I try to teach in pictures to give you that mental movie, if you will, that mental picture, that lesson that will help you understand how important fan lines are. So imagine that this first line here measuring the longer term trend, all I did was connect this low to this low and project it out. Imagine for a moment that we are tracking an airplane or any kind of an aircraft, maybe even a fighter jet, and this is the angle of ascent. So this airplane is going at a fairly steep angle, maybe 45, 50 degrees, and then all of a sudden the plane takes a steeper angle of ascent and starts to go almost vertical. And then this line here, which is measuring the shorter term and most recent trend, I'll zoom in here for you, this fan line connecting these lows is showing an even more accelerated angle, and now this plane is going almost vertical. Now, for those of you who have flown in an airplane, or maybe for those who have even flown their own airplanes, what eventually happens if you continue in a vertical angle like this, almost 90 degrees? Well, whether you're in a commercial jet or even a fighter jet, eventually you're going to hit a ceiling. Even the fighter jets eventually will run out of oxygen going vertical. So my point here is that even the market, as we compare this to a fighter jet going vertical, eventually these vertical moves or close to vertical moves have to pull back. They have to. It's just the law of how the markets work. So when you have three angles in the fan, think of that fan being almost like an accordion effect. You're opening the fan angle here gets vertical. Now when you get three fan lines, that's usually a sign of an exhausted trend. So keep that in mind as I now look at the diamonds. Okay, so Dow Jones Industrial Average ETF. Remember what I said, the Dow theory tracking the 30 economic stocks that are driving our economy. So here we have fan line number one, fairly conservative angle connecting these 2 points. Then I take the last point on that trend, connect it to the next highest low. Then I take the next point on that trend, I extend that out to the next highest low. Then I take that point and extend it to the next highest low. Now with the Dow Jones Industrial Average, we have 4 fan lines. I've never seen any market or stock go 5 fan lines. I've never seen it in 30, how many years now? 35 years. I've never seen a fan go 5 fan lines ever. So what does that mean? It means that the Dow especially is primed for a pullback. Now this, again, does not mean a collapse or a breakdown of the market. It just means that we are extremely overextended and overdue for some type of a correction. Now, when you have 4 fan lines, and I've seen 4 before, again, I've never seen 5, but I've seen 4. Usually when you see 4 fan lines, the first signal or sign will be the break in the steepest angle of the fan. So this line that I'm highlighting right here, being the most vertical, is usually the first one to get broken. And then what happens in 4 fan lines, it'll generally break through the second fan line here and gravitate to the third fan line from the top. So again, this is 1 fan line, this is 2 fan line, this is 3 fan line, this is fan line number 4. Generally, when you have 4, it pulls back to the third in that succession or series of fan lines. Now, if you look at that low right there, that is going to bring us right around diamonds, right around 192.5. Now, that is almost that's about a 1,300 point pullback. Again, 1,300 points in the Dow is not a collapse, but is something that is actually healthy, because if the price action drops 1,300 points in the Dow, this third fan line will most likely act as at least a minor level of support. And then when we see the price reaching that third fan line, we have to be extremely defensive, because if it breaks through that fan line, now we're talking about a major correction that could bring us all the way down to Dow 17,000, which is equivalent to the diamonds being 170. Now, if we get down to Dow 17,000, now you're talking about a 3,500 point pullback. Now, for investors, this could be pretty stressful, actually. So what am I doing? I'm telling people be defensive. Can the market go a little bit higher in the near-term future? Sure, it can, but I wouldn't take everything that I own and go full-fledged long position across the board. This is a perfect opportunity for us to be scaling out of the market, maybe moving to cash on half of your positions in an effort to create what we call buying power. And what is buying power? Buying power is cash. That's all that is. Cash is actually a position. If you're able to sell out of half of your positions right now, whether the market goes higher or lower, you just on Tuesday morning, tomorrow, you just sell half of your position, you now are creating a cash position that will allow you to buy other stocks or maybe an index or two as the market starts bouncing off other support levels. Think about this for a second. Let's say you're an investor and you are 100% vested in the market, and the market starts pulling back. What are you going to buy with? Well, especially if you have an IRA, you can't add more money to your IRA to get into a new long position, so you're stuck. If you don't do anything to move to cash or create buying power, there's nothing you can do to create more opportunity if the market pulls back and bounces. So again, the handwriting is very much on the wall here. I'm not, again, saying the sky is falling, but there are major signals that are telling me that we could very well see a pretty significant pullback. and you might want to prepare for that. Now, as I look at the spiders, SPY, that's the S&P 500, we see 3 fan lines. Now, if I go to a daily chart now, again, looking at the spiders on the daily chart, this is really an interesting chart here, because we have, again, this is the most accelerated fan line that I have, and look at that. On Friday we have a bullish engulfing pattern. Isn't that interesting? So again, like I said before, we could go a little bit higher, but again, I'm not going to bet the farm that we're going to continue to go higher. We might see a little bit of a rally later this week, but eventually that's just going to give you more buying power, because if you sell it at half the positions at a higher level than where we are right now, obviously you're going to raise more money to your cash account. And that gives you that, again, that opportunity. Another thing to look at on the S&P is that we have gaps down here. You see this? The gaps? And what I did not show you on the Russell 2000, I'm going to go back to the monthly chart. I hate to hop it. I forgot to mention this to you. Was it the Russell, or I can't remember which one it was. No. Oh, no, that was on Apple. All right. That was another stock. I'll show you that later on the monthly chart. That was pretty incredible. All right. So going back to the daily chart on the spiders, excuse me. I don't mean to confuse anybody, but we have that bullish engulfing pattern right there. We have to keep an eye on volume, because remember that fighter jet analogy that I gave you. If you're going almost vertical, and volume represents the throttle, the amount of fuel you're putting into the engine, if you start to see the volume pull back, like we saw a little bit on Friday, you see we didn't really set another volume high on this bullish engulfing pattern. So we'll have to keep an eye on the volume tomorrow to see if we go higher. That's okay. But if we go higher on lower volume, that's not okay. That's not a very bullish signal. In fact, the drop in volume is a leading indicator that tells us that the buyers are starting to pull back in their enthusiasm and in their buying energy. You see? So again, this is very, very interesting. I tell people all the time, there's nothing wrong with being a cautious bull. Like I said, we can go a little bit higher, but don't bet the farm. And what I would still do, even on any kind of an uptick this week, I would still look to scale out of some of those positions to create that cash. Remember, cash is a position, and you got gaps down below the market. S&P, here's a gap down here. There's a gap down there. There's a gap that still hasn't been filled. There's gaps all the way down here in the S&P down around 210, which would be a significant correction if we came down to fill that. Now, a gap trading, again, for those of you who are brand new, if you go to the Market Guys website and click on the video tab, there are videos in there, one of which, the first video at the very top left of the video page, is going to talk about fans and how to draw fan lines. And then I think if you scroll down to the third row, it'll talk about gap trading. So those are 2 videos that I'd like to highlight for you. Those, again, are free videos that will help you understand what we're talking about here with regard to some of these trading strategies. Okay, let's look at the Qs now. QQQ. Actually, I could even put a 4th fan line here on the daily chart. But I'm not going to do that. I'll wait till next week to see what happens there. If you look at the Qs, which more or less represents the NASDAQ market, again, we have a bull market from Friday on slightly higher volume. So we could see a little bit of an uptick here on Tuesday and Wednesday. But remember, keep an eye on that volume. We've had a very long stretch of green candles here. On Thursday, we had a red candle spinning top right there, and that is usually the first sign of a pullback or a pivot point when you start to see these spinning tops. So again, long stretch of green candles tells us that's a stale green candle. We're eventually going to start pulling back and seeing some red. Okay. All right. Now, you have any questions on this? Oh, hey, David. I just saw you. I saw your note there. Okay. So, what did I miss? Spiders. We had the Russell 2000, the diamonds, the Qs. Yeah, I think we cover that, and of course the VIX. Now, um, one of the things that we are promoting here at the Market Guys is, of course, the weekly market report. Let me tell you a little something about why I like to promote that to the general public. The more people who look at the technical signals, and this almost sounds like manipulation, but it's not. Hear me out on this. The more people that we have, or the larger the crowd that we have who is watching the technical signals, the more accurate the technical signals become. Now, again, the people who are more into the fundamental analysis will argue the point of, oh, well, that's just, self-fulfilling prophecy. Of course, if you have 2 million people buying on a hammer pattern like we see here, you see the hammer pattern? That's a very bullish sign. If we have 2 million people buying on a hammer pattern here or a gap fill here, of course the market's going to go up. And my argument to those folks is, well, so what? What's the difference between 2 million people buying on a hammer pattern, which is a buy signal, or 2 million people buying on a buy recommendation from an analyst who's looking at the fundamentals? Yeah, it's half a dozen of one, six of another, and you have a very clear buy signal that people react to. But here's the advantage, and why I am such an advocate, and even you could even call me a technical analysis ambassador, is that the technical signals give us an instantaneous buy signal when we know how to read them. Where if you're following an analyst, it could take them 2-3 days or 2-3 weeks before they can crunch the data on the fundamental reports to give you a buy or sell recommendation. Here, if we can teach the general public how to read supply and demand on a technical chart, we all make more money as a result of that. And in fact, we can make more money on and have stronger percentages of accuracy than the professionals who are crunching the data, who are not looking at the charts. So I tell you, when you get the market report, send it out. Send it to your friends. Of course, you want to send it to people who have an interest in investing and trading. Don't just send it to anyone just for the sake of sending it. But try in your own areas, try to be your own ambassador to this world of investing and technical analysis, because the more people we get, sorry about that, the more people we get to follow the signals, the more money we all make as a group collectively. So this is really exciting, and especially when you start learning about fan lines. Okay, now, Bill, I think has a question. How far below support should you put your stop to try to avoid getting stopped out and then see the market take off? Okay, that's a great question, Bill. And let's back up. Let me use, and I'm sure someone's going to ask about this, but I want to show you something that I found to be very, very odd. Let's just put it this way. This is Apple, AAPL. Now, over the past 6 months, you may have read about this. Warren Buffett took a 10% stake in Apple Inc. Now look at this. This is a 3-year chart of Apple. 3 years of data. Let's go back and just look at the last 6 months or so. You see this? In the past 6 months, there's really only been 1 week right here. See this week back in September? There's only been 1 week where we had pretty impressive volume. And even on that one day right there, we still only had, well, only, but it's a side. We had 390 million shares trade in that Now remember, this is a whole week. Now think about this for a second. Warren Buffett came in and invested billions of dollars in Apple. Here's the strange thing. I don't see Warren Buffett's volume reflected anywhere in this chart. So you see, if Warren Buffett came in, he never would have just bought on one day. He never would have sunk billions of dollars into buying Apple in one day or even 1 week. He would have spread that volume out over a long period of time as not to more or less move the market on himself. Here's what I'm talking about. Let's say Stuart, Larry, and David decide they are going to take all of their money and they're going to buy into Apple. And they know that they have enough money that if they all started buying today, it would push the market up and now hurt them. Now, we did see the market go up in Apple here. Again, this is a weekly chart. But look, a lot of times the volume went up. See, in these 3 weeks, the price went up, but on super low volume here. Look at this. This is a bullish engulfing pattern on that week. Look how low that volume is. You see? So again, Larry and Stuart and David know they're not going to do this all in one day because they're going to move the market makers away from them and they're going to have to pay a higher price. So the way to do it is to gradually go into the market. Now, I have seen, over my 35 years, I've seen a lot of manipulation. And I'm not saying, Warren Buffett is wrong, and I'm not saying he's even lying about what he's done. I'm just telling you there's something very odd about this chart, because even if Warren Buffett went around the market and went directly to Apple to buy shares, and you can do that, by the way, you can circumvent the market. If you're a billionaire looking to buy stock, you can buy stock on the curb. You don't have to do it during the market while it's open. You can move large chunks with institutional traders outside of the market. There's no law that restricts you to just trade through the New York Stock Exchange or through the NASDAQ. There's no law that says you have to do that. But if let's say I'm Warren Buffett and I buy $500 million worth of the stock from the institution overnight, here's what happens. The institutional trader now has to offset that position somewhere along the way while the market is open. You understand? So I don't see, if Warren Buffett came in and bought billions, I don't see the offset volume being traded anywhere down here. It's not there. It's not represented. That's number one. Now, number two, look at the monthly chart. This is a 20-year monthly chart of Apple. You notice anything? Who sees something that's literally popping off the page? Who could tell me if they see anything odd on this monthly chart? Does anyone want to even take? Oh, okay. Larry sees it. David sees it. Donna sees it. Okay, a lot of people see it. Okay, Sal, Bruce, Ken. Yeah, see this? In 20 years, never in 20 years has Apple gapped up on a monthly chart. Look, I'll zoom in. It's never happened. Look. Now, we only have a couple of weeks left in February, okay? I highly doubt that in the next 2 weeks Apple is going to drop to fill this gap. I highly doubt that Apple is going to drop $13 in the next couple of weeks. I don't think that'll happen by the end of February. However, I do think Apple will eventually fill the gap. So what I'm saying here is I think Warren Buffett is set to lose maybe billions of dollars when this gap fills. Now, I am recording this because I wanted to go on the record that I am actually going against Warren Buffett's decision to buy at this particular point in time. I'm going completely against it. If I would not be doing that as a money manager. So again, for the record, and I'm going to even go so far out here, I think Apple is eventually going to come back to fill this gap. Because again, history shows there's never been a gap on a monthly chart, number one, which means it's a 99.99% chance the gap will eventually fill. Because as odd as it is to see a monthly gap, it's going to be even a stranger event if the gap doesn't fill. Because gaps on monthly charts, you can go at any stock, any index, with the exception of companies that have gone bankrupt. 100% of gaps on a monthly chart fill. 100%. Again, unless the company is going bankrupt. That's the only exception to that rule. Otherwise, 100% of the gaps found on monthly charts fill. 100%. And that's pretty interesting. So the other thing is, and look at this, bullish engulfing pattern on the monthly chart, another big green candle, a gap up green candle. Look what's happening to the volume. Isn't this interesting? Look at that. The volume is dropping. So here's my question. How many of you out there are long Apple? Let's see. Let me go back to my... Raise your hand if you're long Apple or have a long position in the options markets for Apple. Okay, I'm scanning. Okay, Bruce, be careful. Again, be very, very careful. I would look to hedge that. I would look to cover it. I would look to maybe exit it if you have a profit. If you have a long position, chances are you're making money. Looks like, okay, Nathan, same thing for you. Be very, very careful if you have a long position. Again, this is being recorded. Listen, my track record is very, very accurate, and I have a feeling that I'm going to be spot on accurate with this one. So be very, very careful if you're long Apple. Okay, there's only a couple of people, so again, hopefully this information has helped the both of you with regard to how you're going to step forward and manage your position, your long position in Apple. Okay, now let's get to the fun part. I know it took a little bit longer than I usually do going over the markets and talking about some of the price action, but you have to be very, very careful, especially when you're looking into charts. Now, let's go back to answering the question there. And who was it? Bill, I think it was, right? Hold on one second, Bill. Let's go back to answer the question. How far below support should you put your stop to avoid getting stopped out? Now, let's use Apple as an example, okay? Let's go to a daily chart. Let's say you are long Apple. Well, the way you do this is if I'm going to, let's say, draw a trend line on the short-term trend here. Let's exempt ourselves from this gap, and let's look at just this most recent, and I'm not going to call it an upward trend. I'm going to call it an upward leg, okay? If I take the low from this day, project out, try to connect as many of these lows as I can on the way up, and do this, there is a very, very good representation of the short-term trend, aka the leg, the up leg. So, Bill, if you're long this stock, you can obviously see there's a bullish engulfing pattern. You see that? And prior to that, on Thursday, you see a bearish engulfing pattern with the doji there. So I would, if I was long Apple, and I'm not, I would just put my stop somewhere below this trend line. I might even go so far to say I'll put it maybe over the past, I'll put a stop maybe down below the low of the past 4 or 5 days. So here's the low for day 5, from 5 days from today. And I might put my stop right there. Now, that's being fairly conservative, because if I get stopped out because the stock is pulling back, that would be a very well-defined pivot point or inverted V. So if this trend line starts breaking, there's a good chance that this gap will fill. So I'm protecting my cash. Another thing to do, Bill, is putting the stop strategy aside, whenever I see a stock that's so overextended, you could sell 25%, 30%, maybe 50% of your holdings while still holding the other 50% long. So what happens is, even with a bullish engulfing pattern, you could sell 50%, raise enough cash so that if it does correct, you have cash to buy back in when this gap finally fills. You see, and you're still going to be better off than doing nothing and not even putting any stops in. So again, that's called scaling out of a position. The professional traders will scale out on the way up when they start to see volumes dropping, or narrow or very, very small candle patterns at the top, especially when you see dojis or bearish engulfing patterns. They'll start scaling out. So hopefully that will help you. Now, another thing to help Bill is on the video tab, the video library that my partner Bill and I have. There is a video that's entitled "The 1% Rule," and that's going to give you another idea of how far down below support you should set your stops. Okay, because depending on how many shares you have, you might not have a lot of shares. So if you have a light position, you could put your stop way down low and still not subject yourself to a catastrophic hit if, in fact, the stock does turn around and go lower. Okay, all right. Now here we go. Let's put some stock symbols in and let's look at these. And before you put your stock symbol in, if you could, let me know what your intentions are. So in other words, Ron just put in INN, and attached to his stock symbol, he said looking for an entry point. So if you're looking for an entry point, let me know. If you own the stock already, let me know. If you're maybe short the stock, whatever, let me know so I can help you better. So this is INN. Now immediately, Ron, I would say stay away from this if you're looking for an entry point, for the simple reason that, as I zoom in here, you see that we are at a pretty significant resistance level right here. And on Friday, we had a bearish engulfing pattern here with a close below the 20-period moving average here on super high volume down here. So everything that I see in an instant is telling me the sellers are moving in. So I would not do anything with this stock until I see it pull back to either here, which would be a roll reversal support, or maybe even go so far down to here, which would be a roll reversal support. So when I'm looking at a stock like this, I tend to move away from it, no matter what they do. Here's hotel properties, Summit Hotel Properties. I don't like the way that looks on the daily chart, and if I don't like it on the daily chart, chances are I'm not going to like it on the weekly chart. And look at that. This level down here, right around 14.5, actually looks more appetizing to me, because this level right around 14.5 would be a significant roll reversal support level here. You see, resistance, 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 all the way here, resistance was broken here. So once that resistance is broken, it turns into support here. So I would look for a stock pullback here with maybe a bounce there. Then I would like to get in around 14.5, and then I'd probably put my stop around 14 right there. So that's one that I would pretty much stay away from. Now, Ron, what you could do is put in a price alert for the stock. And you have to understand that is not an outrageously low buy point, because it's trading just under 16. So you're looking for 1.5 point pullback. It's not like you're looking for Apple to drop $13 before you get in. This is going to be a $1.5 pullback before it hits its roll reversal support, and that would be a more respectable point to get in. Only, mind you, if you see a bullish candle, green candle, whether it be an engulfing pattern or a hammer pattern. That's the only time I would get in. But in the meantime, keep it on your watch list, put your price alert for 14.5, and then take another look at it then. Okay, now Sean is looking at Advanced Micro. I think that's what it is for AMD. Is that right? Yeah, Advanced Micro. And Sean is looking to short the stock at, oh, you shorted already. Okay, good. You're shorted at 13.25. Now, for those who are new to trading or investing, what Sean has done is he's basically borrowed shares from his broker and then he went into the open market and sold those shares. And the goal here is to sell borrowed shares and looking to buy the shares back lower, and then taking those shares and repaying his loan. Now, excuse me. Now for Sean, it's looking very, very good because this is the weekly chart. And we have a red candle with a lower high, not so much a lower low, but the lower high gives us what's called a half signal, Sean, a full pivot point would be a lower low and a lower high. You have a lower high but no higher low, but you have a higher low. That's a half signal. And you have that half signal on a volume bar for the weekly chart that's half of what the volume was the week prior to that. So here's what I would suggest. You have to monitor this roll reversal point right here around 12. Now, Sean, now there's the roll reversal on the weekly chart. Let's switch to the daily chart. See how I go back and forth like that? So if the stock pulls back to the 20-period moving average, which is going to be very, very close to the roll reversal, if you see any kind of a bullish candle, whether it be a doji for a pivot point, a hammer, an engulfing pattern, something like that, a harami perhaps, if you see anything like that when it pulls back to 12.15, I would cover the short. Take your dollar profit, move on. Short strategies should never be a long-term time commitment. They're usually for just a series of days. You're already in a position where you're up a little bit at least, but I would look to cover that short right around the 20-period moving average. That's how I would look at that. Now, Sean, if let's say Tuesday, Wednesday, and Thursday, all of a sudden you see red candles here, and you see the volume increasing, that means that the sellers are getting motivated, and you might see a complete breakdown below that 20-period moving average. At that point, Sean, what you would do is put in a trailing buy stop. So, in other words, if it closes below that roll reversal or closes below the 20-period moving average, put a buy stop just above that area, which is now going to be resistance, and then as the stock goes down, trail your buy stop down with the stock. And then if you get stopped out, you just take your profit. So in other words, the market will basically dictate the exit strategy for you if you're trailing your stop down. I have a question for Sean. Sean, where do you have your stop set now? If you could, just put that in there. I'd like to look at that. Where do you have your stop set? I don't mean to put you on the spot, but I'm a big advocate for risk management. Okay, so you have a stop at 13.57. Okay, that's good. So you'll just, if you get stopped out, you'll just have a very minimal loss on your hands to manage. Okay, that's good. I'm glad you have the stop in there. Okay, so Phil says Microsoft, MSFT, thinking of placing a bull put spread at 50 from the 55.60. Okay, now remember, Phil, what I said about the general markets. Remember, Microsoft trades on the I think it trades on the Nasdaq and it trades on the New York. I have to check that. I think it trades on both. That might be Apple, but I know that the Nasdaq and the Dow are overextended, like I said before. So if you have or thinking about putting a bull market strategy on this, you could wind up taking a hit on that. Now, again, forgive me, those who do not trade options, just forgive me for a moment while I address the question for Phil. Phil is looking to sell the 60 puts, which would obligate him to buy the stock at 60, and then he's buying the 55 puts to protect himself. Now, I think that's a pretty safe bet, but you have to tell me which month that you're doing that in, because if you're doing it, January of next year, that wouldn't be a good idea, because by then, Microsoft could come down and fill the gap all the way down by 54. So tell me, you're looking July. That's interesting. Well, that might not be a good one. First of all, by July, we could already be in the pullback mode, or what they call the summer doldrums. A lot of times people sell out of their tech positions over the summer. They actually start selling them in April and May, and then they go away. Did you ever hear that strategy? Sell in May and go away? That's where that comes from. A lot of people after tax season will sell their positions and take a vacation over the summer, and they won't get back in until after the general sell-offs in September and October. So I don't feel comfortable with that one, but I don't want to tell you not to, because it's pretty far down below the market. The market would have to pull back 8% on Microsoft for you to get hurt or threatened with that, and it would have to pull back. Oh heck, it would have to pull back almost 15% before you would take a total loss in that. So I think there's better spreads out there. I really do, Phil. I think there's a lot better spreads. I don't know if you subscribe to the option oracle, but we put credit spreads out, and we generally do pretty well. We took a loss in PCLN last week, but all the other spreads are making us money. So if we take a hit in one, we have other positions that we're making that loss back in, and it kind of evens it out. So yeah, check into that. Again, I don't have my subscriber list with me, so forgive me if you're already a subscriber and I didn't know that. But I think there's better candidates out there. Okay. All right. Ken is looking to buy JKS. Now, Ken, I imagine that's an equity trade. You're not doing any options. Okay. Now, folks, look at this. This is Ken's suggestion. This is why I love to invite people to our open house, because you will get so many ideas about trading, and some of the best candidates come from the questions that are thrown at me from the audience. Now, immediately, Ken, what I see here is actually what's called the cup and handle pattern. Here is the cup, and here is a little bit of a handle. It's a little awkward. It's not the textbook, textbook cup and handle that you would see, but the brim of the cup is right here. And it looks as though the stock is breaking out over the brim, which is a buy signal for a cup and handle. And look at this, folks. As I zoom in, what's happening to the volume? There's two things that I want to point out. Let's see if the audience can find that for me. Okay, I see the stock breaking out over resistance, but what else am I noticing here? Can anyone point that out? Those who are seasoned, market guy followers, what else am I seeing that's leading me to believe that the buyers are coming in strong? Lloyd got signal number one, higher volume. You see? We have a green candle as it's breaking out over the resistance on higher volume. That tells us the buyers are in control. What's the other sign? Who could put that? Oh, there it is. No one's pointed it out yet. Nathan came close. Bullish green. That's a bullish engulfing pattern. You see that? Bullish engulfing pattern on high volume. Bullish engulfing patterns are accurate about 80% of the time. So another way to look at that is, when you see a bullish engulfing pattern, there's an 80% chance the stock will rally. Look, here's the evidence. Here's a bullish engulfing pattern right back here. See? Big green candle, the body of the candle engulfs or overshadows the red candle. Look at that. Mere 2 days later, the stock rallies and kept going. Let's see if I can find any other bullish engulfing patterns on this one. Probably will. Let's see. Any other bullish engulfing patterns? I'm looking. Yeah, here's one right here. Bullish engulfing pattern, big green candle, overriding the small red candle. Boom, it went up. Here's another bullish engulfing pattern, and mere a week later it took off and just went through the roof. Okay, so Ken, I like that idea. I like the idea of a long position, but you have to also keep in mind that as bullish as this looks right now, it's a cheap stock, trading around $16, $17. It's a cheap stock. You have to use the 1% rule for managing risk on that one. Just don't get in over your head. Try to keep the mathematical formula that we use for the 1% rule. Keep that active, and just don't go too far over your head. Now here's an example. Let me just use this. If the way to calculate how many shares you should buy is all contingent upon two numbers: your risk amount, how much you're willing to risk of your account, and your risk per share. Now follow me here. Let's use an even number of $100,000, and you can extrapolate this any which way you like. Let's use the $100,000 as the model account. If you have a $100,000 account and you're using the 1% rule, your risk amount will be, here we go, simple calculation, whatever 1% of that account value is. You follow? So if we have a $100,000 account, 1% of that is $1,000. Now, that's the risk amount. In order to calculate or figure out how many shares you should buy, you take the risk per share. And what is that? Well, let's say I buy it at 17 tomorrow, and I want to put a stop at 15, maybe somewhere below the 20-period moving average. My risk per share is going to be $2. Again, if let's say I buy it at $16.77, and I put a stop at $14.77, $2 below, because I want to give it $2 breathing room. The way I figure out how many shares I get to buy is I take the $2, the risk per share, and I divide that into my risk amount, i.e. $1,000. So that tells me that I could buy 500 shares, no more, no less. Well, you could buy less, but certainly no more. And if I buy 500 shares and I get stopped out, I'm only going to lose 1% of my account. So if you have $50,000, then only buy 200 shares, 250 shares maybe. If you have $5,000 in your account, your risk amount is $50. So you got to figure that out. Just figure that out with the risk per share, risk amount, and then don't trade it over your head. That's it. Wow, I got to step it up. Holy mackerel, we're almost an hour into this already. Can't believe it. Okay, let's go. Now some of you wiped out. Let me go to Stuart. Stuart is looking at NUGT, looking at buying NUGT. Now, for those of you that don't know about this one, we make money on this one. This is one of the ones we trade quite often in the Equity Oracle, the trade candidate service that we have. Now, Stuart, I'm going to ask you a series of questions, and the lineup of my questions will basically give you the answer, okay? So, my first question is, what color is the candle? You don't have to type it in. I think you all could see that it's red. That's number one. Color of the candle is red. Okay. Now, what type of a candle pattern is that? Well, if you've done your homework, that is a bearish engulfing pattern. What happens 80% of the time when we see bearish engulfing patterns like we see here? Well, here's the example. Bearish engulfing pattern. Shortly after that, NUGT collapsed. Here's a bearish engulfing pattern. Next day, it collapsed. If we go back even further, look, bearish engulfing pattern. 2 days later, it gapped down. Let's see if we see any more. I think you're getting the point here. Bullish engulfing pattern here results in upward moves. So if I see a bearish engulfing pattern and the moving average is just below that price action, I do not want to be buying that. So here's what we do. We draw some lines. We draw some horizontal lines. If this is a former resistance area right here, I will draw that across, and try to find a good role reversal point. Form a resistance, broken here, turn to support here. So this is my new support level. So a good entry point for this would be somewhere around $9. And this is one of those leveraged, this is 300% leverage on this. So if the gold stocks start to go down, this will go down 300% that of the gold miners index. Okay, so this one actually can get down to 9. If it gets down to 9, I'm telling you, Stuart, I would be a big buyer of this one, because $9 for NUGT. I mean, I could almost find 2 or 3 other trades to make that money back. Even if I bought it at 9, I can find ways to pay for that entirely at $9. That's pretty cheap. I think NUGT anywhere below 10 is a good one, because it generally bounces from there. So that would be my entry point on that, right around 9. Okay, hopefully that helped you. All right, now looking for, all right, Sandy has, oh yeah, I'll take Sandy's, because Sandy talks about GDX rather. GDX is also a gold miners, and you see Sandy we looked at in NUGT also applies to GDX, because this is not a leveraged instrument. This is what NUGT would actually follow, but do so 300% more volatile. Okay, so here we go again. This is a time where you could look back at history here. You can see this used to be a resistance area back there. It's right at a resistance point. So you certainly don't want to be getting in when you have a bearish engulfing pattern at a resistance point, and you certainly don't want to get in when the candle is red and we have higher volume. Last question of the night to all of you who've been following us for all these years. What does it mean when you have a red candle, or especially a bearish engulfing pattern, and the volume is higher? What does that mean? What does that tell us? Who wants to be the first to answer? I know we have a little bit of a delay there, so I'll wait. Okay, let's see. Answers are coming in, are they? Let's see. Yeah, Sal, you're right. Lloyd, you are right. Ken, you're right. Okay, all of you are right. When you see higher volume on a red candle, it tells us the sellers are motivated, or the sellers are in control. It is bearish. So all of you who answered are right. So I would suggest, again, for GDX, same thing would apply, same strategy for NUGT. I would pick a role reversal point. I think it could come back as far as 22 on that one, actually. I think it could pull back. Now, for those of you, I think it's important that in the SLV market, which is also precious metal, I sold. Now, my wife and I actually have a pretty significant position in our retirement accounts in SLV. I sold out of half of my SLV position, half, and I very well may sell out of the rest. Now, silver is looking a little bit more bullish than gold, because you have a green candle followed by a doji, but you don't have a bearish engulfing pattern. So I'm looking possibly at selling out maybe this week of the rest. And the reason I do that in a retirement account is because if you're trading in a retirement account, number one, you don't want to overtrade it. That's your retirement money. But you don't want to risk too much either. And so you can't, if you see a good opportunity, you can't just plop money into your retirement account. You can't do that. It's not, the IRS is not going to be happy with you putting money in when you're not contributing to it. So you have to be patient. You have to find creative ways for creating buying power within your retirement account, and that's how I do it. I scale up, sell out of on the technical signals, and then I'm looking for silver to pull back to fill this gap down here. These are my lines from my own personal analysis. I will get right back into silver when it gets back down to 1640, and I could see that gap filling, and then I'll get back in. So, did not run out of content. I did not run out of stock symbols, thanks to you, but I just ran out of time. And for the members, please know that my partner Bill will be posting this recording to the member page, so you didn't have to take such hard notes. And for those who are brand new to the Market Guys, we are taking a list of people who might be interested in our one-on-one mentoring program. We don't have any openings right now, but we will probably over the next 3 to 4 weeks. So if you're interested in that, just ping me, send me an email. AJ@theMarketGuys is where you would go, and then we can talk about that and see if there's a strategy that fits you and your financial planning for trading and investing. So again, this is AJ Monty, Chief Market Strategist with the Market Guys, signing off. Thanks for joining. We'll talk to you soon. So long.
For almost 3 decades, AJ Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep-it-super-simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is AJ Monty, Chief Market Strategist for the Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our trade alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have 2 services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, We're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for the Market Guys. Thanks for watching.
Enrolling in this service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.